Well, it looks like the US have just cut their rates only 8 hours ago. Did we get the notification? What does that mean for Australia? It now really puts pressure on our RBA to drop the rates. Now, I know they're planning to put the rates on hold. That was the bet. But now everyone's looking to see if they're actually going to drop rates. What does that actually mean? But let's have a look. So the US cuts rates, puts pressure on RBA. It could get things heated, right? So now we're talking about the official rate at the moment is 4.35. Now, with them cutting their rate by 0.5%, that means that now it puts us into a position of, do we do that, right? Further, our leading economist is now saying here that we're tipped for a rate cut now in February as an on-flowing effect, right? Because we've got cash-strapped households. But what is more interesting is here on the 9 News is that the ASX now predicts 4 rate cuts in the next 12 months. And what does that mean to homeowners? Now, this is really interesting because I'm going to show you what that means for you as an investor if you buy now in the market, and what you're going to gain in terms of cash flow if you invest now, and what happens when the rate cuts. So make sure you tune in for the full video for the workout. Now, it talks about the mortgage holders could be better off by hundreds of dollars a month if the Australian Stock Exchange forecast on interest rate is right? This is the first time the Reserve Bank began its long chain of rate hikes since 2022. The market's the first time in all of this time is predicting its 4 rate cut in the next 12 months. That is massive, right? Now, we know that when they put the rates up, it was a trigger reaction to the housing prices going kaboom, right? And they literally put it up until they could pull that back and also slow down inflation. Now, inflation is still sitting a little bit higher. It is going to be coming back into the predicted range. Our employment is staying pretty stable. So really, there is no justification for them to cut rates just yet. However, the global economy is what Australia is ultimately part of and need to consider. And when we see the US cutting rates, that's a signal that households are in distress, people are cash strapped, there is defaults there. And in order to stabilize the economy, the expectation now is that they will cut rates, right? Now, but what is more surprising is now they're going to cut rates by 1%, so 4 times, right? It's a 0.25 cut in February, and the next 3 more leading up to August 2025. We are in September now. That is in the next 12 months. It's going to have 4 rate cuts. That's equal to 1% difference of what the current interest rate is. So how does that matter to you right now in terms of money in your pocket? Let's work it out. Let's see what happens if you're buying $1 million property today versus what happens to that property in 12 months time when the rate cuts, and why you should be buying now versus buying then. Now, let's look at this. Let's say you're buying $1 million property, right? This is now, this is 12 months time. That's the 2 differences. Now, let's say you're borrowing 80% LVR. So that's 800K, right? You're borrowing 800K. You're putting in 200K as a deposit, plus there's $50,000 in, let's say, costs like stamp duty, legals, pest and building, etc., right? But let's just work on this 800K and how much money you get. Now, remember, the key thing to remember is in commercial, everything's quoted as a net rent versus a gross rent in residential. What does that mean? It means that your tenant pays for all the outgoings. It means when they quote you a 6% net, it means that the tenant's paying you $60,000 on $1 million property as a 6% net, because $60,000 is 6% net of $1 million. And on top of that, your tenants are paying for insurance, land tax, management fees, water rates, council rates, and anything else that's to do with the actual property. So that's not coming out of the $60,000. If you were investing that $1 million into residential, you'll find that it won't even get to $60,000, because most $1 million around Sydney and Melbourne, you're buying a 1-bedroom apartment. In Brisbane, you're probably buying a house. But what you're getting, the rent's probably going to be somewhere around, at most, $800 a week, which means that it just flows through to around that $42,000 a year before outgoings. And when outgoings gets taken out, you're probably short about $10,000 to $15,000 on that property. Right now, and in about 12 months' time, you probably are still a little bit negative with it, but less negative, right? But in commercial, this is where the magic happens and where the rate drops, everybody goes out and celebrates because you're getting more cash in your pockets, right? You're not getting a little bit less negative, you're getting literally more cash. So how does that actually work? So let's look at this. Now, 800,000 now, interest rates at 6.75%. So interest rates at 6.75% means that you're paying about $54,000 in interest, right? This is your interest repayment. paying $54,000. Now we know that this is a 6% net yield, right? So when I talk about net yield, it's before mortgage, but after all outgoings. Now 6% is what you would get right now, roughly 6% in about metro properties. You'll get a strata office space, strata retail space, maybe a little warehouse in Melbourne, in Brisbane, in maybe fringe Sydney, or you might be getting them definitely in regional areas way above that 6%. But in metro areas, you can definitely hit that 6%, right? So that means it's $54,000 to support the loan on this property. Now you're getting $60,000 in rent. So your rent is $60K. Now your mortgage is $54,000. You're left with positive cash flow of $6,000, right? That's your situation now. And of course you might say, but Helen, my $200,000 I put into it, there's a cost to it because I'm drawing that down from equity from a investment property, or that I'm actually got money, it's money sitting in the bank, I could get 4%. Of course. Now we haven't accounted for that because we're trying to compare with apples, and I'm trying to give you a really simple summary, right? So yes, if you're doing 100% finance on this deal, you might be slightly negative right now. However, what's going to happen in 12 months time as the interest rate comes down by 1% as predicted by some of the economists? Now, so we're at 6.75, 1% is 5.75% in interest. 5.75 on 800,000 is now $46,000 in interest repayments. So that's the interest repayments in 12 months time. You see the difference, 54 versus 46,000. Now, what happens in commercial property when the tenant pays all the outgoings is that difference goes straight down to the bottom line in your pocket. More money. Extra holiday, maybe to pay for renovations, right? So what does that mean? Let's say that the tenant is paying still $60,000 a year in net rent, so that's the rent, right? And let's say they didn't even put the rent up in the 12 months, right? Well, this happened. Now, you've only got to pay $46,000 instead of $54,000 in terms of repayment in the loan. What do you have left? You've got a whopping $14,000 left positive in your pocket, right? When the Reserve Bank cut its rates for 4 times in the next 12 months as predicted by economists. Now, what's the difference? There is an $8,000 difference between what you're getting now as positive cash flow or what you're getting in 12 months time. Now, why is it so good to buy now? It's because right now, people don't want to buy. They're struggling, they just don't want to buy because they don't predict, they can't see the future. But the moment we have one rate cut, people are going to start thinking of buying. By the time we have a second rate cut, they're going to get in and start buying. So what will happen is you'll see that at that time, the $1 million property is no longer $1 million. It's going up in price, right? So instead of $1 million, they're probably paying $1,050,000 for that. So you are likely to pay more in 12 months time for the same property than you do today. Yes, it might mean that you're a little bit negative if it's 100% borrowing, but it means you'll definitely be positive when you have the interest rate rise. But also, it means that if you start with a little bit of cash flow, but buying it at a time when less people are buying this market, you're going to benefit twice as much in the future when everyone else jumps in the market. So the key is to buy now, work out your strategy, work out how the numbers work out where to buy so that you get both on the back end of this, not only the cash flow in your pocket, but the exponential growth as well, so that you can have your cake and eat it too. So if this is the kind of property you want to invest in and you need someone to handhold you, give you the strategy, show you where to buy, what to look for, then you need to click below and book in for a free strategy session, because here at Unikorn Commercial Property, I help everyday Australian become wealthy through commercial property, and I want to do the same for you as well. Right now is a perfect opportunity before the rate cut comes in February 2025, which is predicted by the articles of the economists. You have a chance to get into the market before the rest of the crowd, and you have a chance to really capitalize on that, and you don't want to miss out. So make sure you get the right advice, the right team behind you, the right mentorship and hand holding. So do check us out, and in the meantime, if you love this video, comment, thumbs up, subscribe, spread the word, and I'll see you in the next video. Bye for now.